this is kind of a short section, but these myths are pretty prevalent. One of the myths that we see is that you have to pay 20% down. Dad, why do people believe that myth?
Well, so if you don't put 20% down, there's a mortgage insurance required. And this mortgage insurance, depending on the program and the product you're doing, depending on the lender that you're using, depending on your FICO score, if you have a low FICO, government loan, this mortgage insurance can be pretty expensive. But if you have a high FICO, you've got good qualification, then it's not that expensive, especially on the first time homebuyer program. So putting 20% down does avoid mortgage insurance, but if you don't put 20% down, there is a mortgage insurance. Now, what is mortgage insurance?
I think I got it. There we go. Yeah.
You want to talk about that, or do you want me to?
Yeah, keep going.
Okay. Well, mortgage insurance is a cost that allows you to get a loan without putting 20% down, basically. And who does it cover? It doesn't cover you as a borrower. It protects the lenders, and it protects the lenders in case there's a foreclosure. Lenders want to make sure that you have skin in the game. And part of that, if you don't have that much, they want to have an insurance policy that protects the lender in case something happens and they have to take that property back. Usually it costs about 20% to take a property back, remarket it, fix it up, and sell it.
Yeah. So basically you're paying the insurance premium monthly to cover the lender.
Correct.
Once you hit 20% equity, what happens?
So if you hit 20% equity, and if you've been in this home for about a year, I think you have to have it for at least a year. But after let's say you pay extra, you pay it down and you have 20% equity, you can petition to your lender, whoever's servicing the loan, and you can petition to have that dropped. Now, it's a little bit different. When you're petitioning to drop, it's not 20%, it's 22%. They want to see you have 22% or 78% loan to value. Normally, the lender will ask for an appraisal to be done. Once that's done, everybody feels comfortable. That will be dropped. You won't have to pay it any longer.
Mm-hmm. And depending on the size of the loan, your mortgage insurance, it can be hundreds of dollars. So this is something that you want to drop off as soon as possible.
Yes.
You don't want to make, no one wants to make extra payment. Yeah.
The other way to get rid of is not paying it, but actually allowing the home to increase in value. In the last few years, homes have increased in value quite substantially, and we've been able to drop mortgage insurance.
Yeah. If you bought a home in 2019, it did absolutely nothing more than just paying your normal payment. In 2020, 2021, your mortgage insurance most likely dropped. A lot of people, I think in general, in the Phoenix area, homes appreciate in value $100,000.
Correct.
So yeah, it can be dropped in a couple of ways. Another idea, and I wanted to bring this graph up. This is the median U.S. home sales price since 1960. So this is the cost of homes. Dave Ramsey is fantastic for a lot of things.
Yeah, I like him.
He has a great budgeting advice, and it's not just him. There's other financial people like him that recommend you've got to put 20% down. That's not a bad idea. It's a very low risk idea, but the issue is that number can move and appreciate over time.
Right.
Do you mind sharing? I know we kind of have an example.
Well, I have an individual,
someone.
Right, that he said, I'm not going to buy a house until I have 20% down. So he waited. And yes, he had the 20% down, but the house cost more, and he lost out on an opportunity to build equity. Every individual is different. This may not be for you. You may want to put 20% down. That's fine. I'm not saying don't do that. But a lot of times getting into a home with 3% down and building that equity and having the opportunity to pay it down and drop the mortgage insurance later is a good option.
Yeah. Again, everyone's different. It depends on your risk tolerance. Also probably depends on your income type. If it's stable and expected to continue, then you might be willing to be a little more risky. If it's, up and down, then maybe it's a risk you're not willing to take, but just something to be aware of. You don't have to wait till that 20% down.
Right.
And in fact, I'd probably say the majority of people we work with don't wait for 20% down.
Well, it's hard. If you're a first time home buyer, you just got married,
80,000 is a lot of money.
It's a lot of money. If you're going to be you're planning to put down roots, you know where you're going to live. I would say go ahead and take advantage of the first time home buyer programs. The MI is cheaper. You're going to get a better interest rate on a first time home buyer program. They make it very attractive. So it's not always worth it to wait.
Yeah. So another common myth that we get is down payment is that covers everything. It's the only money needed to close. That is not the case. Every lender and mortgage broker we should probably all have uniform language, but this is how we look at it. Is I was pointing the wrong direction. You have the down payment and then you have closing costs, and those together are the total cash to close. Common closing costs are the appraisal, title company fees, title insurance, real estate commissions, attorney fees. These are all fees that will be with every transaction. And that together equals total cash to close. So we don't want you to think that you can buy a home for $9,000. A $300,000 home for $9,000. There's more to it. It's not just the down payment. So that kind of goes into, you got to be ready to budget. And before I clicked one slide ahead, closing costs vary. It varies on the size of the home. That's really the biggest one, the size of the home, the square footage,
right,
the type of lot and the land it's on.
Purchase price. So getting title insurance on a $600,000-$700,000 home is more expensive than getting title insurance on a $300,000 loan. So there's a variable on some of the items that we're talking about here.
Yeah, we wanted to give you a rough estimate, and this is very subject to vary. Things will go up and down. But just keep in mind that the closing costs in general are around $5,000 to $8,000. They could be lower, they could be higher. We just want you to understand that it's not just a down payment; it's down payment plus.
Yeah, we're trying to describe a concept to you of what it takes. We're not telling you exactly what it is. If you want to know the exact numbers and you have an exact amount that you're thinking about, or you say, I want to buy a house in this range, we can be much more specific and help you out there.